In just 6 months, the United States went from shipping over 160,000 barrels of oil a day to China to shipping none. Zero. A silent 10% tariff from Beijing. No announcement, no press conference, just closed the door. While American media debated wind turbines and campaign rallies, the world's largest oil buyer pivoted, not to allies but to Iran and Russia. Now U.S. ports are quiet, pipelines are slowing, and Trump? He's blaming everyone but himself. But this wasn't just about tariffs. It was about something deeper and far more dangerous for America's leverage on the global stage. Welcome to Geo Capitalist, where we decode global wealth, one power shift at a time. If you want serious breakdowns of the moves that actually shape our world, not just headlines, hit subscribe. This story isn't just about oil. It's about why America keeps losing buyers, allies, and leverage. Let's get into it. For years, American oil exports to China symbolized a fragile but functional trade tie, a rare moment of balance between two giants who rarely agree. But now, that bridge is gone. In early 2025, China introduced a 10% retaliatory tariff on U.S. crude. At first, few paid attention. It wasn't front-page news. There were no fiery speeches in Washington, no televised backlash. But within weeks, the impact became clear. Oil tankers headed for Chinese ports were rerouted or simply canceled. Shipments dropped from 160,000 barrels per day to zero. One of the world's most important trade flows just disappeared. And the U.S. response was silence. This wasn't just economic policy. It was geopolitical calculation. China didn't shut the door loudly. It quietly walked away, while locking in long-term deals with Russia's Rosneft and Iran's National Iranian Oil Company. These are not democratic allies. They are strategic bets, countries willing to sell oil without lecturing Beijing on human rights or geopolitics. And in Beijing's eyes, that matters more than ever. While American leadership argued over pipelines and protesters, China built energy security. And as one Chinese official put it bluntly in a closed-door forum, "Why buy oil from a country that insults you on the world stage?" A sentiment quietly shared by more than one buyer in Asia, Africa, and even Latin America. This wasn't just about barrels. It was about dignity, strategy, and signaling. And the world got the message. The United States once believed that oil was its unshakable advantage, the commodity no rival could afford to lose. But in 2025, China called that bluff. When Beijing added a 10% tariff on U.S. crude, it wasn't just testing prices, it was testing patience. Instead of protesting or lobbying for carve-outs, Chinese importers simply rewrote their contracts with Russia and Iran. By March, China was importing a record volume of Russian seaborne crude, up nearly 25% from the previous quarter. Simultaneously, Beijing inked new energy infrastructure deals with Iran, creating long-term corridors that bypass dollar settlements altogether. This wasn't reactive policy, it was strategy in motion. China knew the U.S. would spin it as a tantrum. But this wasn't about headlines, it was about leverage.
As one Chinese energy analyst put it, you don't keep buying from someone who slaps you publicly, then demands a tip. The point was clear.
America's aggressive trade posture, especially under Trump's second campaign wave, made it politically impossible for Chinese officials to keep buying U.S. oil, even if they wanted to. This quiet decoupling didn't stop at oil. Petrochemical deals followed, then rare earths, then metals used in American solar and EV manufacturing. One by one, sectors that once depended on mutual benefit became strategic exits for Beijing. Meanwhile, American tankers waited, but no orders came. And who picked up the slack? Russia, Iran, and Brazil. Yes, even Brazil is now negotiating yuan-denominated oil contracts with Beijing, a direct shift away from U.S. financial channels.
Because when the world's largest oil buyer makes a decision like this, it echoes far beyond energy. Trade flows follow trust, said a senior analyst at the Energy Policy Institute. And right now, America is running a trust deficit.
Across the Gulf Coast, oil tankers sit idle. From Galveston to Corpus Christi, these billion-dollar beasts were once symbols of U.S. dominance, pipelines to the world's largest economies. But now, they're waiting, not because there's no oil to sell, but because the buyer, China, quietly left the table. This isn't a crisis CNN will headline, but ask a port manager in Texas or a trader in Houston and they'll tell you something shifted. Exports to China once accounted for over 17% of U.S. crude shipments. Today, that number has plummeted to nearly zero. And unlike a market drop, this isn't just cyclical, it's structural. Ports are still operating, but volumes are thin. Storage tanks are fuller than expected. And refineries, once fine-tuned for export margins, are reconfiguring for a different reality. Some local contractors have already been let go. Maintenance schedules are being delayed. Revenue projections quietly revised downward. And yet, the American narrative hasn't caught up. The national headlines still talk about energy independence, as if that means everyone will keep buying. But geopolitics doesn't work like that anymore. Today, it's not about how much oil you can produce. It's about who's willing to buy it under your terms. And right now, fewer countries are saying yes to those terms. Why? Because trade isn't just about price. It's about alignment. And, for many nations, watching the U.S. escalate tariffs, spark financial sanctions, and politicize every barrel of oil, the message is clear. The cost of doing business with America may be too high, even when the oil isn't. Let us know in the comments. Do you think the U.S. overplayed its hand? Or is this just temporary retaliation? What shocked most analysts wasn't that China reduced oil imports from the U.S., it's how fast they replaced them. Practically overnight, Beijing dialed down U.S. shipments and dialed up orders from Russia and Iran. In fact, by mid-year, China had signed multi-year supply agreements with both, some of them reportedly in non-dollar currencies. To understand the scale, just look at the numbers. In January, the U.S. was sending China over 160,000 barrels per day. By April, 0. Meanwhile, Russia filled the gap, not just in volume, but with favorable pricing, discounted freight, and no public drama. Iran followed suit, offering crude under the radar and routing it through shadow fleets, often blended into Malaysian barrels. The result, China gets the oil it needs. Washington loses leverage, and the dollar loses ground in global energy trade. This isn't just a supply chain story. It's a diplomatic shift. China is essentially building an oil ecosystem where U.S. influence doesn't reach. No dollar dominance, no sanction threats, no political lectures, just contracts. That's what many buyers want now. Predictability, not pressure. This moment exposes something deeper. The U.S. believed it held all the oil cards: production volume, refining expertise, military protection of sea lanes. But in 2025, production isn't power if buyers can get what they need elsewhere, from partners who don't criticize them on the world stage. The oil didn't disappear, it just moved east. And as it moved, so did power. We're now entering a new oil era where alignment, not allegiance, decides who trades with whom. And the U.S.? For the first time in decades, it's learning what it feels like to be quietly skipped. On paper, energy is a commodity. Barrels are barrels. Prices fluctuate with supply, demand, and global shocks. But that's only half the story. In practice, Oil flows toward political alignment. And China's sudden rejection of U.S. crude wasn't just about tariffs. It was about trust. Think about it. Why would the world's biggest oil importer continue buying from a country that calls it an enemy every other week? Why wire billions to a supplier that could turn every transaction into a press conference? While American media framed China's pivot as retaliation, Beijing's messaging was muted. No threats, no noise. Just a quiet change in routes. In their eyes, it wasn't personal. It was rational. As one sharp comment put it, why buy oil from a country that insults you for buying it? This isn't unique to China. Other countries are watching. The Philippines, Indonesia, even some Gulf states. They see how quickly U.S. foreign policy turns economic tools into political leverage, and they're adjusting. That's why this moment is bigger than oil. It's about economic autonomy. In a world of 7.7 billion people, 195 countries, and dozens of trading blocs, buyers don't have to tolerate suppliers who act like gatekeepers. America believed access to its markets, and its energy, was a privilege. But that illusion is fading. As one viewer noted, imagine the rest of the world trading with each other until the U.S. decides to behave. That comment wasn't angry. It was realistic. Oil diplomacy has changed, and so has the price of being unpredictable. When China stopped buying American oil, it didn't stop buying oil. It simply picked new partners and sent a message. In recent months, Beijing has quietly ramped up long-term energy contracts with Russia and Iran. Not spot trades, not opportunistic discounts. Multi-decade pipeline deals that bypass the U.S. dollar entirely. This is what Washington didn't anticipate. That the world's largest oil market, once a symbol of American export potential, would build its own back door. China's state refiners are locking in shipments from Russian ports at pre-sanction prices. Iranian crude is flowing through gray networks with open approval. And with each barrel, American leverage slips further away. A decade ago, this would have seemed unthinkable. Iran was isolated. Russia was sanctioned. The dollar ruled. But now, the global oil order is being rewritten. Not in headlines, but in shipping manifests. The kicker? There's no need for public defiance. China doesn't need to announce it's dumping U.S. oil. The data speaks, from 160,000 barrels per day to zero, all while import volumes from Russia quietly surged past 2 million. Some in Washington argue this is temporary, that China will come back. But here's the uncomfortable truth. Why would they? Buying from U.S. suppliers now means dealing with political conditions, future tariff threats, and dollar-based volatility. Buying from Russia or Iran, fewer strings, longer contracts, and growing alignment through BRICS+. This isn't a pause, it's a pivot, and America's not holding the pen anymore. It's easy to think this story ends with China, but the effects are being felt far beyond Beijing and far closer to home. In Texas, oil export terminals that once ran at full capacity are now facing idle time. Gulf Coast shipping routes, designed to feed Asia's hunger for U.S. crude, are seeing reduced traffic, and the financial pain is starting to show. Companies invested billions in infrastructure based on a simple idea, that the world, especially China, would keep buying. Now those pipelines are still running, but the destination has changed. It's not Beijing, it's uncertainty. At the same time, Washington is doubling down on political theatrics. While global demand realigns, the headlines are filled with sound bites. One day, it's about energy independence. The next, it's about banning certain exports altogether. But none of it addresses the core issue. The U.S. built an oil export strategy on buyers who are no longer buying. And here's where it gets more complicated. This isn't just about crude oil. It's about influence. For decades, Oil was one of the few areas where America could still exercise global leverage. Deals came with conditions. Supply meant diplomacy. But now, countries are finding alternatives and calling Washington's bluff.
As one analyst put it, America overplayed its energy hand and underestimated how fast the world could fold it.
So while Trump blames tariffs and Biden blames markets, the truth lies in the ports. Quiet, still, and no longer essential. The U.S. used to assume one thing, that if it drills it, the world will buy. But what happens when the world quietly walks away? China's shift wasn't just economic, it was symbolic. It sent a message to every oil producer on the map that the rules are changing. No more unconditional loyalty to American markets. No more silent acceptance of political friction. Today, the world's largest oil buyer is rewarding consistency, diplomacy, and alternatives. And the result? U.S. energy dominance, a pillar of foreign policy since the shale boom, is starting to fracture. Other buyers are watching closely. India is increasing its oil imports from Russia. Gulf nations are inking multi-year deals with Asian clients. Even longtime allies in Europe are hedging their bets with alternative sources. Because if China can cancel 160,000 barrels per day with a 10% tariff and no warning, anyone can. This isn't just about barrels and ships, it's about credibility. America's oil exports were once a symbol of strength, but now they're becoming a casualty of diplomatic missteps, tariff escalations, and short-term thinking. And here's the twist. The U.S. didn't lose this market because it couldn't deliver the oil. It lost because it forgot that in global trade, respect is part of the price. The pipelines may still be flowing, but influence is what's running dry. If you found this breakdown valuable, watch our next video. It connects directly to what's unfolding. And don't forget to subscribe. Your support helps us decode these global shifts without compromise. Let us know in the comments, is this economic pushback justified or just politics at day and disguised as policy? Either way, the world is watching. This was why the world's largest oil market just dumped the U.S. and no one saw it coming.